Hey, what's up everyone, and welcome to the School of Personal Finance. So with interest rates still hovering around record lows and the refinance boom still in full effect, I wanted to do a video to try to help you determine if it might make sense for you to refinance. So I'm going to cover things like how to calculate your break-even point, how to figure out how much you're actually saving each month by refinancing, choosing the correct term, calculating closing costs, all the stuff that goes into the decision if you should go ahead and pull the trigger and refinance. All right, let's get to it. If you're new to the channel, I post videos once a week all about personal finance, investing, real estate, and overall just trying to help you become great with money. If you enjoy that kind of content, please make sure to hit that subscribe button and a little notification bell, and also go over and check out schoolofpersonalfinance.com. I have my own financial planning practice. You can learn more about the ways that you could work with me if you'd like me to be your financial advisor. All right, let's get into it. So the big reason that people typically refinance their home is to save on interest. A good rule of thumb is if you could save like 1% or more, it might very well make sense for you to go ahead and pull the trigger and refinance your home. But it depends on a lot of different factors. Some other reasons that people will refinance are maybe to cash out, pull some equity out of their home, or maybe to consolidate debt. If they have a lot of high interest rate credit cards or student loans or car loans, and they want to wrap it all in to a 30-year mortgage to reduce their monthly payments and have more cash flow. Another reason could be to go from a 30-year mortgage down to a 15-year mortgage. Another reason that people will refinance is if they're in a much better situation than they were when they initially applied. So maybe their credit score is much higher. Maybe they have PMI on their mortgage right now and they have enough equity in their house where they could go ahead and refinance and get rid of the PMI. So there's a lot of different reasons where it might make sense for you to go ahead and refinance your mortgage. So the first question you need to answer to see if it makes sense for you is how much can you actually lower your rate by? And you have to know how to shop lenders to compare apples to apples when looking at rates. So obviously you need to shop around. Do not take the first quote. Do not walk into your regular bank that you use, go sit with the loan officer and go ahead and go through with the refinance. You definitely need to shop a few different places to make sure that you're getting the best deal. So when looking at the rate, you want to see, are you paying any points? So you could pay a point and buy down the rate, get a lower interest rate by paying like 1 point is equal to 1% of the loan. So if you're doing a $300,000 mortgage, 1 point would equal $3,000 that you pay up front to get a lower rate. Or there could be the reverse. You could actually get a lender credit. You could get a higher rate on your mortgage and get credited towards the closing costs so you don't have to pay anything out of pocket. So in comparing one lender against another, you have to make sure that you're comparing apples to apples. So that leads us into the second question, which is how much is it going to cost you to refinance? And are they wrapping those closing costs into the loan, making your loan amount bigger than you started with? Or are you going to have to pay out of pocket? So now with banks, again, you need to compare apples to apples. So there are lender fees. They might charge you an origination fee or an application fee or an underwriting fee or a doc prep fee. These are all junk fees. They're all lender fees where you could compare and look at one bank to the next what they're actually charging you for those services. But then you're going to have other fees as well. So you're going to have things like title insurance, or like in New York, we have a mortgage tax. There are other costs that are going to be associated with the loan that you want to have itemized, and they'll be shown in the loan estimate where you can actually look at what these costs are. And then you have things like your prepaid items, your homeowner's insurance, your property taxes. You're paying that no matter what. So this isn't really a true closing cost. This is them just setting up the escrow account and having you fund it initially, but you're going to get reimbursed. You're going to get a check from the mortgage that you're paying off. So it's really a wash. So you have to understand what are true closing costs when doing this so you could compare one lender to the other and also see if it's worth it. How much does it actually cost you to refinance the mortgage? And then the third big question that leads us into is how long are you going to stay in your home? There's going to be a break-even point where the monthly savings that you're going to get from refinancing are going to surpass the amount that it costs you to actually refinance. So that's what we call the break-even point. And I'm going to show you in a little bit how to calculate that so you know exactly when your break-even point is going to be. Then the next question is how much are you actually saving every month? So what is your new payment going to be compared to the old payment? What is your monthly savings? And now you can't stop there. You also have to calculate what is your overall savings? How much are you going to be paying for the overall life of the loan compared to the loan that you have left that you're refinancing? So for example, if you have been paying for 5 years and you have 25 years left on your loan and you go ahead and you refinance, even if you're saving some interest, into a new 30-year loan, you just added 5 additional years that you're going to be paying off this mortgage. So you have to calculate the overall cost of the new 30-year loan compared to what you have left on the 25-year loan. And I'm going to show you how to do that as well. All right, so let's use the example of a $300,000 30-year mortgage at 4% that we're looking to refinance. And this is actually the same amount that I used in my other video called How to Pay Your Mortgage Off Faster. You should go check that one out after you watch this one. So we're going to take this mortgage and we are going to refinance it. And the current interest rates, let's say, are 3% on a 30-year loan. But now we've been paying into this loan for 5 years, so we have 25 years left. The monthly payment on this loan, the principal and interest, is $1,432. And we currently owe a little bit over $271,000 that we have left on the mortgage after paying it for 5 years. So now we're going to look to refinance this thing into another 30-year loan at a 3% interest rate. And the closing costs, we're going to wrap the closing costs in. So I am guesstimating that the closing costs are going to be somewhere in the ballpark of like $3,600. So that is going to bring our new loan amount to $275,000 for this new loan. Now for the closing costs, I touched on this a little bit earlier, but you want to be able to break out exactly what the true costs are. So not the prepaid items, not the money that's going into an escrow account, because you're paying your taxes and insurance no matter what. You want to look at the lender fees, and you want to look at the underwriting and the appraisal fee and the third-party fees that you don't really have much control over, even though they say that you could shop for those things, but they're going to be a cost to the loan that you're going to have to pay. The price for them pulling your credit report, for the title work, all of those costs are true costs to you refinancing. If you're paying any points, the application fee, all that BS, those are true costs. Those are what you want to use when calculating what the actual closing costs are going to be and when we do the break-even calculation next. Now for this new 30-year loan at $275,000, because we wrapped the $3,600 and change of closing costs into the mortgage, our new monthly payment is going to be $1,160. So we're going to have a savings there, a monthly savings by taking out the new loan of $272 per month. And now the next thing we want to do is we want to calculate our break-even point. And what I mean by that is, how long will it take for us to have enough monthly savings to recoup the amount that we had to pay in closing costs to refinance the loan. So in this example, our closing costs, we're going to say were $3,650. And our monthly savings are $272 per month in our lower mortgage payment. So that means that it would take a little bit over 13 months for us to recoup all of the closing costs that we paid. So if we were only going to live in this house for a year or so, then it makes no sense to go through this whole hassle and process of refinancing, because we're not even going to make back the amount that we had to lay out in closing costs in this situation. Now, another way that we could compare this is the overall cost. So we could compare, if we do nothing, if we just let this mortgage ride, compared to the overall cost over the next 30 years if we refinance. So if we do nothing, if we keep this 4% mortgage for the next 25 years, because we've already paid 5 years off, the overall cost for that would be $429,675. And the way I calculated that was just by taking the monthly payment of the $1,432.25 and multiplying it by the 300 payments that are left on that mortgage. If we compare that to the overall cost of refinancing into a new 30-year mortgage at a 3% interest rate, the total cost of that would be $417,600. And I get that by just taking the monthly payment of $1,160 and multiplying it by 360 payments. So we can see here, it still costs less overall for us to go ahead and refinance, even though we're paying for an additional 5 years on the mortgage. Now, refinancing into a 30-year mortgage is not the only option. You could also refinance into a 25-year mortgage. This way, you keep the term the same as your original mortgage. So by doing this, you're still going to lower your monthly payment down from $1,432 a month down to $1,304 a month. And the overall cost of the loan for the next 25 years would be $391,000. So this is the best option out of all of them, and it's probably the one that I would personally do if I was in this situation. So just for kicks, let's say you wanted to do a 15-year mortgage and bang this thing out. Your interest rate would be lower. You'd probably be able to get around a 2.5% interest rate now. Your payment would go up by about $400 a month. So your new payment would be right around $1,833 per month, but the overall amount that you spend when it's all said and done 15 years later would be $330,000 on the mortgage. So obviously you pay the least by choosing this option, but your monthly payment's going up by $400 a month and you're done 15 years from now instead of going back to a 30-year term or even compared to the 25-year term. So if you could afford, if your goal is to pay your mortgage off as fast as you can, then this is obviously going to get you there, the fastest way. Now, it makes the most sense to refinance if you could kill two birds with one stone. Like, for example, if you could eliminate PMI and get a lower rate, then that makes it that much better. Or if you could lower the rate and lower the term. Now, as far as debt consolidation, I am not a fan at all, because now you're taking consumer debt, if it's credit card debt or if it's car loans, and you're wrapping them into a 30-year mortgage. You're paying it off over 30 years. To me, that doesn't make any sense at all. Instead, I would leave the mortgage the same and just focus on paying off those debts as quickly as possible. But overall, I think that the best case scenario for refinancing is when you're saving on the interest, you refinance into the same term that you currently have, and then you also keep your monthly payment the same. So even if your payment is reduced by a couple $100 a month, stick with the old payment so that you're paying even more to principal. This is going to be the best way to not affect your lifestyle at all, but you're saving a ton of money in interest and cutting years off of your mortgage. This way, you're taking advantage of the situation, you're getting the lower rate, but you're not changing your cash flow, nothing else changes, and you're going to be done with your mortgage that much faster. I don't know how anybody could argue that that does not make a ton of sense to refinance in that situation. All right, everyone, that is it for this one. I hope that you enjoyed that video. Please make sure to hit that subscribe button if you haven't done so already. Hit that like button if you enjoyed this video. I will see you guys again next week. Thanks.